All right, so the first thing I'm gonna do is just go over that little quick one that I gave you to do, just playing with the operating activities. Then we're going to review what we did the other day as far as that one problem, and hopefully we are going to finish it. So that's one I want. So basically, this one was number 2, right? And you just had to take the information. You had to find the difference in the accounts. That's the amount that goes in here. Remember, it's always the change. So it told you what the net income was, which goes here. Told you what the depreciation was, goes there. And then these are just simply differences in the accounts. Make sure when you do an increase and decrease that you look and make sure you're going from the old year to the new year as far as whether it increases or decreases. So for example, accounts receivable increased. That's what you write here. It's kind of like 3 steps. Write the increase here or decrease, whatever it did. That's just the words. Put the number in, whatever the change is. And then in your head go, okay, it's an increase in a current asset. That means this has to be the opposite. And then just go down through all the current assets, current liabilities. So you only had ones that you were going to use in this problem. Remember, as far as your current assets go, never, ever, ever cash, because that's the answer, and you'll see that today. If you see marketable securities, even though they're current assets, they're not going to go in this section. They'll go in the middle section. Because typically if marketable securities are in our problem, they've been sold. And so then we're dealing with gains and losses. These are all your current assets. If you look at these 3 current assets, you see that they are all opposite. Increase, decrease, decrease, increase, increase, decrease. Go to your current liabilities, write what it did. But with current liabilities, remember the exceptions there are dividends, anything to do with financing, do not go here. You can see after we reviewed the whole thing the other day that they're going to go in the financing section. And these have to be the same. Increase, increase, decrease, decrease, increase, increase. Add those up. That's your total adjustments. Add that to your net income. Gives you your cash flow from operating activities. As I said, this part is usually the longest part, but I think it's the easiest part because it's pretty straightforward. Any questions on that? Remember, if there's no questions, you understand because you're not asking me questions and I just keep going.
And there's no need to separate out assets and group them together and with subtotals when you have this few entries. Okay.
There isn't a need to do that even if you have a lot. Just list them. Okay. You'll see some formats will separate out the depreciation from all this other stuff, but I just list it all. All right, I want to go back to what we started the other day. And this was the additional information. This is problem number 18. And again, as I told you, if you see these problems that have required questions, we're not doing required questions, we are doing the cash flow. So let's start. This was the first piece of additional information they gave us. We had investments that cost $10,000 and they were sold for $5,000. So we have to do 2 things. We have to figure out gains and losses, and we have to figure out what goes on in the accounts. So the first thing was taking the cost, which was 10, sold it for 5. So therefore we have a loss of 5. It was worth 10, only got 5 for it, so we have a loss of 5. Questions there? When you're analyzing the accounts, when you put stuff in the accounts, you put it in at cost. When you take it out of the account, you take it out at cost, regardless of sale, regardless of anything else. It's got to come out at exactly what you put it in at, or your accounts aren't going to balance. Okay, it's got to come out at exactly what you put it in at. So the cost, so remember, we always know 2 parts right off the bat. And that's the beginning balance and the ending balance, because they come right off the balance sheet. The stuff in the middle, at some point, we're going to have one of the pieces of information. Remember, this subtotal is just a subtotal. You're not going to actually do anything with it. It's just to make the math easier. So this is my beginning balance. I know I sold an investment that cost $10,000, so I'm subtracting it off. That gives me a subtotal of $100,000. I have to get from 100,000 to 105, which is my ending balance. And so therefore that means that I purchased something. Again, when we're doing these, do not think about cash flow, because cash flow is actually the opposite effect. Do not think about cash flow right now. When we get done with all our doodles, we'll go back and then we'll start looking at all the changes on a cash perspective. Everybody okay with investments?
Yeah.
Okay. Now, when you have something with dividends, or you have the net income, these 2 accounts always have to be done together, because what affects one affects the other. This case, they told us the dividends paid were 30,000. Went to the balance sheet, picked up beginning balances for both dividends payable and retained earnings, and the ending balances for the same. And now we're going to go see what we have. Okay, so the information they gave us was that dividends were paid. Dividends paid will always decrease the dividend payable account. And so we're starting with our beginning balance, subtracting off what we paid, and we actually get a negative subtotal, which is fine. We'll fix it. If your subtotal is negative, in order to get that ending balance, you add those 2 numbers together, because whatever you put in here has to cover your negative balance and has to cover your ending balance. So the increase in dividends payable is always what was declared. This is what the board of directors declared they were going to pay in dividends. Questions on dividends payable?
Sorry, can you just repeat that last part? That ending balance is always going to be what's going to be declared, or?
No, the plug
Or-
number is what's declared.
Okay.
So this is your subtotal just because of what we had.
Mm-hmm.
In order to go from a negative subtotal to a positive ending balance, what we have to plug in there is the total of the 2.
Okie doke.
Okay, dividends declared affects retained earnings. And that's why we had do these 2 accounts together. It increases dividends payable, but it decreases retained earnings. And so once I figured out what that dividends declared was, I go to retained earnings and I subtracted off my beginning balance. That gives me a subtotal of 5. The other thing that affects retained earnings is the net income. And the net income increases retained earnings. And so to go from 5 to 70, I have to add in 65. And so now we have our net income, which was not given to us. Questions on that? And you see how they relate together. So this is affected over here. So it's added in one spot and subtracted in the other. Okay? All right, and that's kind of where we stopped. So we had a van, cost $20,000. It was sold for $5,000, and it had a book value of $3,000. So we knew the cost, we knew the book value, we knew what it was sold for. So book value versus sold, we know that we have a gain of 2. Everybody okay with a gain? This is kind of where we left off the other day.
I'm sorry, how did we get the negative 17,000?
Hold on.
Okay.
I'm going to get there. Are you okay with this piece here?
Yeah.
Okay. So book value is found by taking cost minus accumulated depreciation.
Okay.
And so we have to plug that accumulated amount in there because they didn't tell us.
Okay. All right.
Okay.
Thank you.
Yep. All right. Everybody okay with that? So when you sell a piece
Wait,
of...
I'm sorry.
Go
You
ahead.
said cost minus the accumulated depreciation is what?
Book value. So in this
Thank
case,
you.
because we had book value and we had cost, we had to work backwards. Because
you.
when you sell something, everything that has to do with that sale has to be taken off the books. Okay, everything having to do with that sale has to come off the books. All right, so I'm going to go and I'm going to get my beginning balance. Let's see, what do we have? Equipment is 240. Ending balance is 320. When you're doing these with the accumulated depreciation, ignore the parentheses. All the parentheses are doing is identifying the fact that it has a credit balance with a bunch of debits. But when you're doing this, ignore them. So we have a $20,000 beginning, a $50,000 end. Check and make sure I got those right, and I do. All right, so let's see what we have. We sold a piece of equipment. That piece of equipment cost $20,000. When I bought it, I put $20,000 in my equipment account. So when I sell it, I have to take $20,000 out of my equipment account. Okay, does that make sense? I put it in at 20,000. When I sell it, I take it out at 20,000. This is the equipment account. And this is why when you're doing depreciation entry, you never put the depreciation in the equipment account. We put it in the accumulated account. The equipment account only holds the cost. So to go from my subtotal to my ending balance, what number do I put in there?
100,000.
Okay. And what would that 100,000 be?
That would be a purchase of equipment.
Is everybody okay with that? Because we increased the number from here to here, it means we went out and bought equipment. Now, the other thing with that piece of equipment is it had accumulated depreciation. That accumulated depreciation is sitting right in here. And again, if I'm getting rid of this piece of equipment, anything to do with it has to come off the books. So I'm going to take that, go over here, and I'm going to subtract that off the books, which gives me a subtotal of 3,000. To go from 3,000 to 50,000, I have to add what number?
Uh, 47.
Okay. Now, what is that 47? What increases accumulated depreciation?
Depreciation expense.
Correct.
I actually have a question.
Yeah, go ahead.
Actually, I think I just answered it myself, but I'm going to ask it anyways. For the accumulated depreciation, you're removing the 17,000 because you're getting rid of the equipment, and therefore you're
Yes.
not holding on to it anymore. The accumulated depreciation.
Right. So anytime you get rid of something, anything to do with that something has to come off the books. Otherwise, your accumulated depreciation would get so big, it would be bigger than the equipment that you currently had.
Okay, thank you.
Okay, anything else with that one? All right, the next piece of information that we have has to do with marketable securities. Now, do you see marketable securities on your balance sheet?
No.
So that means the beginning balance and the ending balance are what?
0.
0.
0. But something happened in those accounts. So you can't ignore it. So the beginning balance is 0. Ending balance is 0. Okay. The other thing that we have with marketable securities is we bought some, we sold some. So let's look at what we sold. All right. So it tells us that we bought some during the year. And the ones that we purchased cost us $5,000. When we sold them, we had a gain. Oops. $2,000. So what does that mean we sold them for?
$7,000.
7,000, right? Okay. So under marketable securities, we bought some, they said that cost $5,000. So then our subtotal is $5,000. We turned around and we sold them so that the cost of what we sold was 5,000. And so we subtract off the cost of what we sold. This one may seem a little silly to you, but if you don't put it in, your cash flow is not going to work. So we purchased one during the year that cost us $5,000. Turned around and sold it during the year, and we had a gain of 2. So we bought it for 5. We sold it for 7, but the cost piece comes out of the account. So just because there's no balance doesn't mean you ignore it. If you ignore it, it doesn't work. That one's probably the weirdest one in there. Okay, number 5. Assume that retained earnings is only affected by dividends declared and the results of operations. By doing what we did here, we have already done that. Was affected by dividends declared, result of operations. Sometimes they stick that in there, sometimes they don't. It's just telling you that there's nothing else in retained earnings besides dividends declared and net income.
That's even if it's not written down, is that something we assume for this class, or will there be a point where we don't?
Nope.
Okay.
You always presume that for this class.
Okay.
Now the next one, the next two actually go together. So it says assume current liabilities are paid in a timely manner. Sometimes that's all you get. What that means is that if you look at your current liabilities, under your current liabilities, we have a note. Beginning of the year, we owed $10,000. At the end of the year, we owed $10,000. And you might look at that and say, well, that didn't affect cash flow, but it did. Because what that sentence tells you, current liabilities have to be paid in a 1-year period of time. So that beginning $10,000 was paid. Would that affect our cash flow?
Yes.
Yes. And so we need to keep that, or we need to put that in here. So the other two accounts that you're going to work together are your notes payable current and notes payable long term. So the beginning current balance was 10. Ending balance was 10. Beginning long-term notes payable was 152. And an ending of 171. Okay. So when it tells you that all long-term liabilities were paid in a timely manner, they paid this 10,000. Okay, so we paid which gives us a 0 balance. Okay. Sometimes they'll tell you this, sometimes they won't, but it's another presumption that you make. With a current note payable or a current mortgage payable, the beginning balance is always paid. The ending balance is always transferred from long term. We had at least one, I think 2 adjusting entries where we did this at the end of the year. We looked at our long-term notes and we said, okay, what's due next year? And we moved it out of long-term and we put it into current. That's exactly what we're doing here. So this ending balance is going to come out of here. This gives us 142 here. Okay, and that 10,000. Oh, let's see what color I haven't used yet. It's pretty ugly, but we'll use it anyway. It's kind of hard to see. I will go brown. Okay, that 10,000 is going to come over here. And that's how we get our ending balance. So current notes payable. These are things that you want to write down. Beginning balance is always paid. Ending balance always comes from the long term. And then we have to plug a number here. What do I put in there?
29,000.
Okay, and what is the 29?
Long-term liabilities accrued, or yeah, long-term liabilities accrued.
You're making it far too complicated, John. It
Fair enough.
would just be simply what you went out and borrowed. Just means now you owe more money. So it would be just what you borrowed. Okay? Does that make sense? Guess what? We're done. Okay. Any of this additional information that I need to go over again? No?
Can you repeat the last part about the beginning balance of the
Sure.
current?
So you're gonna, with your notes or a mortgage, depends on what you have with a particular problem, you're gonna have a current portion and a long-term portion. And they're either gonna tell you that all current liabilities are paid in a timely manner, or as this one also adds that the current portion of notes payable was reclassified from the non-current. Doesn't matter, it's always what's gonna happen. Beginning balance is always paid. Current part, beginning balance is always paid. Ending balance always comes from the long term. And then if you have to stick something in here, it just means you had borrowed additional money. Okay, ready to take these to a cash flow? Sure
for
you
me.
are. So let's go over here and I'm gonna cheat. Actually, you know what? Let me do this. Let me take it over to that sheet and then we can be looking at stuff as we go. Okay. All right, now I need you to help me fill in numbers here.
Um,
So, go ahead.
65,000.
So now we're going to look at each of these changes. And now we're looking at them from a cash flow point of view. Okay. Now you're looking at them from a cash flow point of view. So we know right here, and you may want to check off because you're going to analyze all the changes, all the increases and decreases in each account that we just did. So you may want to just kind of check them off as we go. All right, so we got net income, right? So John said 65,000. Okay. So here's what I'm going to do. I'm going to say, okay, we did that. We'll fill it in when it's done. Okay. All right, depreciation expense. Where are we going to get that?
You get that from your equation with the van in the accumulated depreciation section of it, at the depreciation expense from there.
So we're going to pick this 47,000, right? Okay. So let me put that in blue. Do we have any amortization expense? Don't
do
have
not.
any, right?
Yep.
All right, I'm just gonna leave it in there. You don't have to put it in there. Okay, so now gotta look at our gains and losses. So did we have a gain?
We had two. The first one being a gain on equipment sold, which was 2,000, and then a gain
Okay,
on your
Wait,
marketable
wait, wait, wait,
securities.
wait. So I had a
Sorry.
gain on sale, and I would suggest that you label because you might have more than one. Okay, so let's talk about this. So we had a gain of 2,000, right? Okay, so then now I know I did this. But, so this gain would have been added already in this net income. Think about the income statements that we just got through doing. Gains and losses were down on the bottom. Gains were added, losses were subtracted. But this section's labeled operating activities. And this was the mistake that people made on the test. Those gains and losses don't belong in those first two sections. That's your operating part. They belong in the third section. So this kind of carries through the same thing as our income statement. So because it's in the third section and it has nothing to do with operations, I need it out of there. And so I'm going to subtract. Okay. All right. Now what, John?
You also have a gain in the sale of marketable securities, which was 2,000 again.
Okay. And see, now you can see why I'm labeling things. Because we had two of them. I'll do that way. Okay, and so now we're going right here. And we had the second gain. Okay, so now we got our gains. Now what?
We
Do we
have
have
a
anything
loss
else? We have a loss, right?
of 5,000 from investments.
Okay, and we're gonna actually add that. And so now we've used this. So those three right there are all in here, but we're taking them out because they have nothing to do with operating activities. And what we're going to do is we're going to include them down here under investing activities. All right, questions on the first. That's all the information that comes off of income statement. Don't take anything else off your income statement. Everything else is coming from the balance sheet. All right, so now I need you to go to your balance sheet and let's look at our current assets and just be careful. You're not using the cash number, so make sure when you pick up the actual numbers that you actually go down a row and don't pick up the wrong numbers and get yourself off sequence. All right, so what are we doing? What's your first current asset? Besides
That would be
cash.
accounts receivable.
All right, and so what did accounts receivable do?
Accounts receivable, we had a loss of $1,000.
Okay, so we have a decrease
I actually had a question.
Uh-huh.
So when you're writing this down, do you have to write that it's like a decrease, or can you
Yes.
just write, okay,
Yes. Number one, it's remember, these are all about the format. And number two, if your thing doesn't come out, you would have no idea of what it was because you didn't write it down and you'd have to go look again.
Okay.
But
Thank you.
yes, it's all about the format. All right, so we said any decrease in a current asset will do what to cash flow?
it will be a gain in operating activities. Or you
It's
added it back in.
gonna increase, right? So here's a case where my printer's doing things and I haven't done anything with it. Huh.
Taunted.
I think it is. I'm waiting for it to spit something out. I'll be curious as to what it is. All right, so if I have a decrease in accounts receivable, it means two things. Number one, my customers are paying currently when they buy stuff. Number two, because it decreased, they paid me off stuff they owed from previous years. And so that's why a decrease in accounts receivable is going to increase my cash flow. All right, now somebody besides John, because the rest of you aren't even paying attention. What happens next? Come on, what's the next one?
Am I allowed to answer?
Go
This is what's keeping me awake right now. I've been awake since 3 p.m. yesterday.
ahead.
Okay. What would come next after accounts receivable would be inventory.
Okay, and what did inventories do?
Inventory had a decrease of $5,000.
Okay, so we have a decrease in inventory. What does that do to cash flow?
You add it back in.
Okay, so it's the same logic. We had all this inventory before. So customers had bought it. And we were lucky because when they bought it, they also paid for it because we saw this decrease. Lots of times you'll see a decrease in inventory and a corresponding increase in accounts receivable because you've gotten rid of more inventory, but some of the people that bought it on credit. Okay, now what?
Should I mute myself?
Nobody else is going to answer.
Would we
No.
have the investments non-current as next, or would we go to the equipment? Because would the investments go down into the investing activities, or are those just for long-term?
Okay. All your long-term assets are under investing activities. So that includes your investments, anything under plant, property, and equipment, and anything that would be under other. So as far as the assets go, this is all we're putting here because all the other ones are long-term. Does that answer your question?
So because this is non-current investments, that would go into the investing activities, because that would be
Correct.
long-term.
Yep.
Okay.
And honestly, you're not going to see a current investment. You will see marketable securities, which are technically current assets, but because you're selling them, they're going to go down in the middle section. All right, so then we need to go to current liabilities. What do you got? What goes here?
That would be your,
Decrease in accounts payable of
Decrease in-
8,000, so you would have to add that back.
Okay, so. All right, so let's think here. Current assets are opposite. These decreased, that increases cash flow. Current liabilities are the same. So let's think about this. If our accounts payable decreases, what's that going to do to our cash flow? What does it mean I'm doing?
it means you're paying someone off, so your cash flow is going to decrease because you're losing cash.
Okay, so I've paid off bills that I owed from last year. So that is going to decrease my cash flow. Just try to remember that current assets are opposite. Current liabilities are the same, which is another reason for writing this stuff out here, because you can go back and check. Decrease better be the opposite, increase. Decrease better be the same, decrease. Okay? All right, what's next?
That would be your notes payable.
Okay, are they gonna go here?
Yes, they would, because it's an operating expense and you're only counting the current notes payable, which we calculated before that we paid off 10,000 worth.
All right, I'm gonna disagree with you. How's that? They are current,
Yeah,
are a current liability, but they're a financing activity.
okay.
And the financing piece takes precedent.
So in terms of notes payable will never go in operating activities. It'll always go down to financing.
Correct.
Okay. Yeah, and I've got a couple of questions, but not for this section. I'm working a bit ahead.
Okay. So we're gonna do that. So I added up my adjustments. And now I'm gonna add my net income and my adjustments. And we've got to hurry because we're not gonna get through this, and that's not good. All right. Let's go down to investing activities. Now, it looked really simple when I put it right here, but we've got investments, we've got a van, and we have marketable securities. Now we're going to look at inside the accounts. Okay. Oh, I'm not getting as far as I want to. I might have to put your test off another day. This is not working here, but we'll see. All right, so let's start with the investment. I have a purchase of an investment right here, and I have a sale of an investment up here. So purchase of investment. Cash paid, and it's going to decrease cash flow. How much did I pay to purchase an investment? Look over here. That's
You
what I
paid
labeled
5,000.
them.
You paid
This
$5,000.
purchase right here, right? So this is what I mean. Don't look at the stuff here when you're analyzing the account, because it's lots of time has the opposite cash flow effect. A purchase will increase the account. That's going to decrease my cash flow. So that takes care of that. Okay, we also sold an investment. But this has to be cash received. How much cash did I receive when I sold that investment?
You received $10,000.
No, look up here. What did we receive? What did I sell it for?
Oh, five. Math wrong. Sorry.
Okay, do you see this? We sold it for $5,000. That's what we're gonna put here. That's our cash received. Cash received, the sale has to include gains and losses. Has to include gains and losses. So that's your investment. So if I look here at the sale of my investment, I got 5,000 here. Up here, I have a gain or a loss on the sale of my investment, right? Of another 5,000, it's a positive. If I add those two numbers together, what do I get? That and that. What's 5,000 plus 5,000?
10,000.
Do you see what this is right here? So those two added together are going to always equal your cost when it's an investment. Just kind of a way to check your numbers. All right, let's finish this section here. All right, we've got a van, right? So we sold a van. How much did we get when we sold the van?
He got 5,000.
Another 5,000, right? That's this. Okay. Do we purchase any equipment?
Yes, we did. For $100,000.
Coming from right here. But what does that do to cash flow?
That'll decrease it.
All right, let's look at the van. Sold it for 5. Up here I have a gain, so it's a -2. So if you add those together, it equals 3. And what does that tie into?
Keep your book value.
See right over here? Okay, and then we have our marketable securities. How much did we get when we sold our marketable securities?
We received 7,000.
Okay. And then we also had a purchase. Oops. Purchase and marketable securities. And how much did we purchase?
5,000.
Okay, so we got the 7,000 taken care of. We got the 5,000 that we purchased right there. Okay, so here's a -5. There's a gain up there, I'm sorry, a 7 is our sale. -2 up here. And what does that give us? Our cost, right? So that to me is the hardest section. It almost always comes out negative because you have a big purchase. Okay, so I'm out of time.
Would you be able to scroll up a little bit? I got something wrong and I'm just checking my values.
All right, so I'm gonna give you a bunch of stuff to work on over the weekend because I gotta move on this. I think you can finish this one because all the information is right here. Financing piece is not hard. Just kind of follow what we did here. If you look at your common stock account, we didn't have any sale of common stock, but you do have a change in treasury stock. So I'm just going to tell you in this one right here, this should be a minus 30,000 because your common stock increased. Okay. So it means we went out and bought more. Oh, I'm sorry. Sorry. I'm looking at the wrong one. 10,000.
Okay.
So your treasury stock increased from 40 to 50. This number right here should be a negative 10, and we'll go back off of over that. I want you to finish this one. I also want you to do number 14. Okay? And then
What
we'll see
page is
where
it?
we're at.
What page?
Hold on. 14 is on page, oh, it's 215 and 216. Make sure you turn the page because the additional
Okay.
information's on the second page. You actually have an income statement with that one.
Okay. Thank you.
All right. So I am going to